I will be demonstrating and backtesting this straightforward EMA scalping technique today, which has a high win rate. The tactic was backtested on a 1-minute period and was successful. Let's begin now that we have cleared that up. The exponential moving average will be the first sign we add to the graph. Look for the EMA indicator by going to the indicator search menu. Choose the trading view indicator and add it to the display. Make sure to hit the indicator twice because we'll need to. Let's now go to the indicator options. Go to the Inputs tab by clicking the first EMA option. I'm going to change the length to 200, and then I'll go to the Style option. To make the indicator more noticeable, I'll alter its hue and thickness. Change the parameters for the other EMA now. To make the line more noticeable, change the length to 50 in the Inputs tab. We'll then adjust the line's color and thickness. All we needed to do was that. Let's now include the final sign in the chart. The ATR indicator can be found by using the indicator search option. Add the indicator created by TradingView to the screen by choosing it. After that, select the Style tab under the indicator preferences. To make the indicator more visible, we'll change its hue. Let's now look at how we will be using the indicators since we won't be changing the input parameters. The EMAs will serve as a fundamental trend direction indicator, and we'll also use them to spot pullbacks and benefit from reversals that result from them. As you can see, we have also incorporated the ATR indicator, which will be used to determine the appropriate stop loss and take profit levels. Let's look at when we will initiate a buy position now that you are clear on how we will be using the indicators. The 50-period EMA must have passed above the 200-period EMA in order for there to be a bullish EMA cross. This is also referred to as a golden crossover, and it shows that the market's present trend has changed to a bullish one. Additionally, we must confirm that the price is above the 50-period exponential moving average EMA. This shows that the price is moving in the direction of the bullish trend and can help us avoid entering transactions in a range or sideways market. Once this has been verified, we will examine the price movement. The price must first retrace to the 50-period exponential moving average EMA, and once this occurs, there must be a reversal indicating that the price will continue to rise. If the following candle closes in the direction of the trend, we will consider the pullback to have been successfully finished. We can be certain that the market hasn't changed trends in this manner. We will take up place as soon as this occurs. We'll look at the ATR indicator, which displays the average true range, to ensure that we use appropriate stop loss and take profit values. This indicator will enable us to select a stop loss that takes the current market volatility into account. As a result, the stop loss will depend on how much the market has changed in the past. As you can see, I have taken into account the ATR's current value, which means that since this is 2 times the ATR value, we will put the stop loss here. We plan to aim for a risk-to-reward ratio of 1.5 times for the take profit. Let's now watch to see how the deal turns out. Here's an illustration of a different entry. First off, the EMAs have made a positive crossover, which means that the 50-period EMA is higher than the 200-period EMA. Additionally, the price is selling above the 50-period exponential moving average, suggesting that the uptrend will persist. This indicates that the second prerequisite has also been satisfied. Thirdly, we can see that the price made a pullback to the 50-period EMA and that it then rebounded off of it, showing that the bullish trend will continue. We'll assume the stance in light of this. The ATR gauge will need to be examined for the stop loss. We can see the present ATR value, which indicates that this is where our stop loss value will be. We plan to aim for a risk-to-reward ratio of 1.5 times for the take profit. Let's now watch to see how the deal turns out. As you can see, the transaction was extremely successful. Let's now examine the best time to initiate a sell position. The following criteria must be fulfilled for a sell position. The EMAs must first make a bearish crossing before anything else. The 200-period EMA is selling above the 50-period EMA as a result. The first requirement has been satisfied because, as you can see, this happened here. Second, the price must be trading below the 50-period exponential moving average, indicating that the bearish tendency is strong and likely to persist. We will examine the price action after this requirement has been satisfied. In order to confirm that the downtrend is likely to continue, we must first see a retreat to the 50-period EMA followed by a bearish reversal. As you can see, this occurs here, proving that the third requirement has been satisfied. As a result, we will take the sell option. We'll look at the ATR gauge to determine the stop loss and take profit levels. As you can see, this is the ATR's value. Let's now establish the stop loss by adjusting this value. We plan to aim for a risk to return ratio of 1.5 times for the take profit. Let's now watch to see how the deal turns out. Okay, so now that you know the trading setup, let's actually do our backtest on a 5-minute time frame and see if the outcomes are reasonable or not. I just finished the backtesting, and these results have surprised me. Our win rate is 70%, and the profits end up at 11%. I would also like to mention that these results will be different when trading live, so always try the strategy for yourself before using it. Guys, feel free to run back and forward testing on various markets and times to gauge how well it performs. If you want to see one of my other trading strategies I use when day trading, check this video right here, because this strategy works great on the every time frame you want. I'll see you guys next time.